Jeff, you're live.
All right. Hey, everybody. Thanks for coming. It's good to see you. My name is Jeff Gibby. I'm going to kick us off. I'm going to read a legal disclaimer and I'm going to introduce our guest. So let's go ahead and do exactly just that. Before I get started, though, if you are tuning in to us with GoToWebinar, what you should be able to see off to the left-hand side of your screen is a question box. If you have any questions, you click on that questions box. You can ask any question and we'll do our best to answer them. If you're watching us on YouTube, hello. I understand. Greg told me one time that if you like and subscribe to the channel, it equals good karma for you. Plus, we really appreciate it. It helps a great deal. If you have any questions in YouTube, just chat them in. We monitor that and we will pass them on during the Q&A. So without further ado, I think I promised you a legal disclaimer. Let's go ahead and do that. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators, features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. MetaStock and its employees do not endorse purchase of a security, nor are they paid for the promotion of the security. No information contained in the presentation today should be construed as investment advice or the solicitation to buy a security. I'm very interested to see today's presentation. We're having David in here for the very first time. He's going to be talking about something that I know very, very little about. So I'm probably going to learn something. We're going to be talking about how to trade treasuries. And it's an often I'm really, really curious to see what he had to say. He comes to us with a lot of experience. We're going to go ahead and turn over the time to Mr. Los. Can you go ahead and turn on your microphones just so I can make sure I have the right one?
Oh, yes, here I am.
Okay, there we go.
Welcome, everybody, and thanks
exactly.
for having me.
Now, I want to make sure I've got this right, too, because I'm not sure, but I think we just pronounce it David.
Yeah, it's David. Yes, that's correct. Yes.
You could hear a little bit of hesitancy there in my voice. I just wanted to make sure I had it right. So
no worries. Yeah.
The presentation to you. Should have asked you if you want to share your screen.
Oh, wait, I never used. Oh, yes, there it goes. And my main screen should be this.
One question I do have is there's a lot of people saying, hello, Jagger, or ciao, Jagger. Is there something that we need to know about that?
Yeah, because my nickname on the communities is Jagger, and both in the Italian communities and the English Discord community. I run the Mr. Order Flow Discord community, and it's in English, and also the Quantistas Italian community. I'm like a collaborator, I would say. So we collaborate, and yeah, so yeah, I'm known as Jagger.
Very cool. Jagger, it's all yours. I'm going to get out of the way. Go.
All right, so I was invited by MetaStock to do this presentation. I'm very glad to be here, and thank you everybody for joining. I have to apologize for my English, first of all, because I'm Italian, I'm an Italo-Polish, so my English isn't really perfect, I would say. I hope that my screen is the right one. I think so. So yeah, we did this because MetaStock is actually, I use it since quite a long time, since before the LSEG took over and brought us Workspace, and so it was still Refinitiv, and I liked it very much since. I know that many of you might be more familiar with Xenit for like equities trading, but it is in fact very powerful for money markets and fixed income markets. And what we specialize, like you might have heard the word order flow. We are mainly order flow traders. So that means that we We basically analyze the flows, the buyers and the sellers, the passive and aggressive buyers and sellers that come into the markets. And mainly we specialize in futures trading. So the futures listed on the CBOT and the CME exchanges. Our main instruments are basically the interest rate futures and the short-term interest futures, more of like an analysis kind of instruments. What is nice about XINIT is that it gives us the ability to look into the underlying main markets. Treasury markets are abnormous, gigantinormous, I would say, and they are at the key, at the heart of any economy, because every economy is based on one of the main keys of governments and how countries are run, even corporate, but we specialize in countries. So we are talking like sovereign debt. They run on debt. It is very intrinsic into our cultures. Debt is and bonds are thousands of years old, and they are based on a promise of a repayment of an interest rate over predetermined time, between somebody that wants to borrow some money and somebody that has that money and wants to and is happy to lend it, getting a yield back. When we talk about sovereign debt, we have like, I will do like a brief, I would say, presentation. I have my Figma whiteboard over here, and this is for later. And I think that I could draw something over here. Yes. So basically, we have the government which has which is a very which is very appropriate that we have the webinar right today, because everybody here in the webinar knows what is going on in the United States. We had the first shutdown since 2018, and it is because the spending bill is not passing. There is not an agreement between the two sides in the Senate and all that stuff with the Congress. This is a different. This is only on the spending bill, but sometimes you might hear about the raise of the debt ceiling. What's the debt ceiling? It's basically the maximum amount that a country could borrow, which is very high in the United States, but the United States is very high because the GDP, what the United States could produce, is also very high. So every country will have it proportionate, and when the debt is higher than the output, so the GDP, we are talking about deficit. When we talk about raising the debt ceiling, it's always going to be raised, because otherwise a country would default on itself, and it isn't something that a country like the United States could allow to happen. So the government needs money to fund its spending. It gives out a plan, and it goes to the Treasury Department. Treasury Department. Sorry, my drawing with the mouse isn't very nice. The Treasury Department is what like collects all the various sources of income, and its main function is to make everything work. So the Treasury will collect taxes, duties, and various other sources of income, but mainly they will issue Treasury auctions. So we will have the Treasury auctions, which are very, very important. You always hear about Treasury auctions. Maybe you see them in the news feed. Maybe the 10-year Treasury auctions, which is very famous, the 30-year, the 3-month bills. So we have the auctions. They, for example, they issue like, we are going to issue like $50 billion of 10-year notes. And then we have on the announced day and time, which is generally at I don't know what time is it in the United States, but it's like 7 p.m. here in Italy, which is UTC +2. And in those 2 minutes, it lasts approximately 2 minutes. It is an electronic auction. In those 2 minutes, you have participants taking their participation in the main moment where the Treasury is issued. Sorry, but for my English, it's quite difficult. So this is the first time where those 50 billions of new notes, for example, if you are talking about 10-year notes, it is the first and the main moment where those 50 billions of notes get into the markets. And this is the primary market. It is the only primary market. Those 2 minutes are the primary markets. The participants in these auctions are mainly primary dealers, other countries, other sovereign, so big participants in essence. The primary dealers play a key role in the auctions because they are like the market makers for the Treasury Department. So it's like they hold everything the Treasury needs, even if there is less participation, for example, from other countries or other big participants. They have to make the market. They have to provide the liquidity for the auction to finish. They might demand a higher compensation for that, which results in a higher yield than what is currently trading, but we will look at it very soon. And so yeah, the primary dealers make the market, so they will take the buy side. This is the sell side. The Treasury government department, the Treasury Department is the sell side in this situation, and the primary dealers and the other countries and so on are the buy side in this situation. The primary dealers immediately take the primary. I should have prepared this, but it's better, like, you know, the teacher at the school he writes, but you know, with the mouse it isn't. So they immediately so here we have sell, and here we have buy side. They immediately turn into sell side by making a secondary market. Secondary markets are OTC markets, or even for example, Jeffrey could go to their bank. They want to buy 10-year notes because they want to build up a portfolio, and they want to buy, for example, $10,000 of 10-year notes. And here you have the bank taking the role of the sell side, and Jeffrey in this case is the buy side. But also we have a big portion of this market, which are the OTC swap markets, which are agreements between banks or other countries, which exchange debt between themselves because of very big amount of reasons that they need to hedge their risk for a reason or another, and so they will exchange those swaps, like the name says. like overnight index swaps on the dollar, interest rate swaps, inflation swaps. Then you have the forwards. There are a lot of them, and they make a very, 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 very big market. We will very soon see what, for example, the CME became in the recent years, became a clearinghouse for many of these OTC trades, and we will see the proportions of how big they are. And so we have the secondary markets. From the secondary markets, from all of this, we have all the very big future markets, which is what is the futures, which is what we trade, because they are leverage money. So here, real money, no leverage money, real leverage. Yes, futures, options on futures, or even ETFs, but they have options on futures, ETFs. These are all leverage money. So what we trade is our futures, and I will briefly show you this is my main execution screen. These are DOMs, and we have the 2-year, we have the 5-year, ZT, ZF. Of course, there is a convention which is the cheapest to deliver. There is it is a very intricate way in how the futures are quoted against the underlying, and there are various formulas, but for the sake of simplicity, we could say that this is the 2-year, this is the 5-year, this is the 7 to 9 year or so, this is the 9.5 year to 10 year, and this is the 20, 15 to 25, and this is the 30. These are the ultra, and this is also the ultra 10 year, ultra 30 year. And so yeah, here we have the basically the yield curve, or in this case we have the future prices term structure. Basically, a yield curve is nothing more than a term structure, basically, which is this wonderful thing. This is our main joy, I would say. This is the yield curve. So this represents the yield that derives from the spot prices. So they are very completely inverse to the prices. So yield are always completely inverse to the prices. What we have here is going from here, you have the 2-year, and here you have the 30-year, and everything that stays below the 2-year and even from the 1-year is called the bills and short-term interest rates. Probably as somebody who doesn't ever heard about or wasn't very much interested about interest rate markets, you probably heard about for example, the 2s-10s spread, which when it is inverted especially signals inflation. So when the 2-year is higher than the 10-year, or vice versa, or whatever, the 10-year yield is lower than the 2-year, we are talking about an inverted yield curve, and that could signal an inversion, but we still have an inversion over here, and we will come back to that very soon as well. And so this is our yield curve. Starting from the left, you have the shorter tenors, which are the starting from the 1 month going to the 6 weeks, 3 months, 6 months, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, 30 year. The other lines are basically the white one is how the yield curve was looking yesterday, and right, yes, correct. And the blue one is 1 month ago. It's a rolling one, so just for like a comparison of how the yield curve is looking over a different amount of time. on my screen here, which is essentially my second screen. I have 3 screens. This is my second screen generally. I have a normal 10-year US 10-year yield chart, the euro as a main proxy against the dollar. So I use this as to look how the dollar is looking right now. I have the overnight index swaps over here, the spot yields over here. Here I got the SOFRs and the overnight index swaps on the SOFR. So let's get back a little moment to our whiteboard over here. We are, as I said, we do trade the futures. Why do we trade the futures? Futures allow us to have very deep understanding and real-time centralized access to what all of the participants in the market across the world, if they are big, if they are robots, if they are small, everybody sees the same thing. So that's wonderful for us because we can base our decisions by analyzing inefficiencies or various different kind of analysis on them. And basically we could measure the magnitude of the sellers against the buyers or vice versa, and also we could look at the liquidity, which are the passive participants in the market, those that are waiting to be filled. I want to show you screen over here. This is, as I said previously, just to show you how big of a market the OTC market is. This is already in the secondary markets. So if I'm a bit disorganized, but let's take a look for a moment at the economic monitor over here. Government debt auction. This is a key part of the software. So here on the government, probably maybe somebody of you always stops here at the economic events, but we have the wonderful government debt auction here, which is derived from also the Treasury Department website, government website lists all of these. So here is what has been issued in the these are the past auctions that we had in the past 30 days. You could see here, for example, the 1 month bills, $86 billion, 83 billions for the 3 months, 6 months, 74 billions, 1 year, 51 billions, 4 months, 65, 1 month, 100. So this is a lot of money. This is a particular, you see, recurrent pattern of 100 billion on the 1 month, which is seems the favorite tenor for the Treasury in this quarter. Why is so? It is because since the latest election and the current president took office, there were a lot of problems with passing and raising the debt ceiling, and there was a lot of delays in passing the spending bills and so on. This is not the first time that they had problems. And the debt ceiling last time we had a lot of delays in being raised, so the Treasury Department had to collect more money in debt faster. So that's why we are seeing such a big numbers over here, which isn't so nice that we have 100 billions and so much money issued in the short-term interest rate, because normally we should lenders should be more attracted to invest into a country, into anybody on the longer term than into short term. But that's very complicated, and it's a particular moment in history, I would say. So yes, so this is like the money that comes out from the Treasury department. Here is a spreadsheet from the CME. If you go over here on the CME website, clear the OTC interest rate swaps, and is the OTC volume tracker, which is basically this spreadsheet over here, and you already see quite big numbers. These are daily and cumulative open interest and totals down here, starting you could see, for example, in 2025, I don't even know how to read this number. It hit millions, 15 trillions of dollars in 2025 in interest rate swaps alone. And volume since launch, it's since 2010 that the CME became an official partner. Important note has to be made is that the CME is the smallest of all the partners. I mean clearing houses, being the Intercontinental Exchange, the ICE exchange being the biggest one. So imagine if the CME is one of the smallest or secondary clearing house, and these are the numbers, you could imagine the ICE exchange, how big those are, just to show you how important and key are interest rate futures and interest rate products overall, and all the work that there is behind. Interest rates regulate a lot of what then also reflects onto indices, onto the FX markets, so the forex markets. Even the forex market is very much influenced by treasury markets, because one of the main drivers of movement on the forex isn't speculation at all. Of course, the forex market is a trillionary market as well, but one of the main reasons of why the forex market, for example, moves is necessity of buying foreign debt. So, for example, if the Germany Treasury wants to invest into United States debt, so take onto notes, bonds, etc., or Japan or China or whatever, they have to buy dollars. By buying dollars, they will exchange their yen or euro, or maybe if they have if they are holding other pairs, for example, they could, for example, the Japan bank could hold the euros, they could hold yuans, rubles, or Swedish koronas, or Swiss francs, for example, and they will use those to exchange them for dollars and to buy, for example, United States debt. So that is one of the main reasons of why the forex market moves. And you can see how this is all interconnected. We could use derivatives and secondary swaps and markets on treasuries to, for example, have a look into monetary policy expectations, but not surveys like economist surveys, but real expectation, because to move determinate products, a lot of money is needed. And if those markets move, it means that participants are putting their money where their mouth is, essentially. And so it is a very, very appropriate and and real way in which traders could express their views on, for example, inflation. If we are talking about inflation swaps, if we look into monetary policy, we have the overnight index swaps. They reflect monetary policy expectations. But mainly what we futures traders use, we use the SOFR futures and Fed funds futures and Euribor futures if we are talking about the European markets. But let's first take a look again at our curve. So getting more into the more technical side of secondary and derivative markets on interest rates. Everybody only talks about for most of the trading world, especially in the retail space and equity traders, the knowledge and starts from the 2-year going to the 30-year, like I said previously. So everything what is before the 2-year, which is very, very important, is completely ignored. Often 2-year is used to see like short-term expectations on inflation, monetary tension, build up, etc. Like the short-term view of the economy in general. Then the 10-year being like the main spread, the 2 and the 10, the 30 like to see long-term views. The 30-year affect mortgages and so on. But what's often ignored completely is all this wonderful space over here, which is much bigger as a market itself than the rest of the curve. We have seen previously, in the, over here, how big the Treasury itself issues in depth in the short term. So we have in 1 month, 4 months, 2 months, 3 months, this makes for more than 300, almost 400 billions of dollars alone, and over the same period we have just 39 billions of dollars in 10-year notes. You could see how the Treasury itself puts more importance into short-term debt than into longer-term debt. So what do we have over here is, if we look at the curve going, like I said, from the 2s to the 30s, you could see that it is normal. It is a normal, healthy curve. I will show you how, just so you know how a not normal curve looks like. It is, let's look at the 2 years ago. This in blue is a inverted curve, because you have the 2-year yielding much more than the 10-year, and this was 2 years ago during full quantitative tightening, high rates, and the Fed is still being very, very hawkish. It was very a lot earlier than they even started pausing. So it was just after the massive liquidity pump into the market and money printing and highly inflationary period that came after COVID. What happened during COVID? It was a black swan to the degree of events like 2008 or the 2000 dot-com bubble. So it is one every decade, or let's hope that it's less than a decade now. But it's one of those events that brings a lot of problems going into the future. It doesn't resolve into a year or 2 years, but every decision that the central bank and the government take has a very long-term effect on economies and inflation and access to liquidity and so on and so forth. So what they did in the after COVID was, like I said, was printing money, lowering interest rates, so trying to save the economy, let's say, so how could I say that? Everybody lived that essentially everybody of us was at home, so businesses didn't work well, banks didn't work well, because if I, as David, stay at home, I don't need to neither invest nor take a loan, so everything goes dust, no? So to save the economy, they started to print money. Printing money has a highly inflationary, it saves the economy. That, of course, it's the effect, it saves the economy, but it has a long-term effect. So as soon as they started to print money, they already knew that they're going to bring a lot of inflationary pressure on the market, and that it was going to create problems. So then in 2022, they started to raise interest rates, and what Powell said during that infamous meeting was, we are going to raise rates at a fixed rate, at a steady rate every month until we reach 5.5%. And I could show you where is my trading view chart. It will be easier to show you if I go this, if effective federal funds rate, yes, 1 day, thank you. And there we go. It was actually, yes, it was 2022. Can I make this bigger? So here you have 2022, and this is the effective federal funds rate. It's like one of my favorite ways to plot the federal funds rate. So the rate that is set by the central bank, which moves in ranges. So they set a target rate between in quarters, it moves in quarters. So for example, 5.5 to 5.25, and that is the range that where they want the overnight rates to be. So they regulate the overnight. You see the link between overnight and the Fed and the overnight index swaps, etc. So it's very interesting, and we could talk about it a whole day. So they started to raise rates, and what Powell said during this meeting over here, it was that they're going to raise rates until the range of 5.5 and 5.25. Nobody was believing it. What happened during this time over here was the regional bank crisis, which was basically the regional banks called I don't want to say that word, but it will be very appropriate. So they said, no, we don't believe the Fed that they will raise rates so much, so they refused to exchange their bonds, bills, and whatever that was yielding not so much for new bonds and bills and notes. So they essentially went bankrupt because they didn't have enough liquidity to sustain their errors, basically, and the Fed had to intervene and save them. So we got to 5.33 as an effective Fed funds rate. It was in this range over here, and the last year at during the symposium, the 1 month before this September FOMC, Powell announced that they were actually going to lower their rates, which they indeed did over here, and they stopped over here in September. No, it was December the last time, because we had a new winner as the United States president, and due to his announced policies, the federal bank thought that there were going to be inflationary pressures, and so they decided to stop. What they did during this phase over here was holding rates because of this expected inflationary pressure, but they had overlooked they have a dual mandate to control inflation and at the same time make sure that the employment stays solid, and but they were basing their decision on incorrect data, which we have seen in the past 2 months. With the revisions, it was incorrect data, so the jobs market is much weaker than they expected, and here we are with them cutting again and getting, I have a line already here drawn. This is where they should land. If we want to, like, I very much like to show this example of how important this part over here is. We have 2 ways, the overnight index swaps, but what I like very much is the SOFR futures. What's the SOFR? The SOFR is the secured overnight financing rate. So it is presented the future is presented in 1 month and 3 month tenors, and the SOFR is basically a substitution of the LIBOR, and it is a transaction-based overnight interest rate. So before the SOFR, the overnight lending rate, yield rate, was set by agreements, like not really a word agreement between banks, but it was a bit sketchy, I would say, and there was a big scandal of how it was working, and so the SOFR was born. Secured stands for, it is now transaction based, so for the yields to move overnight, there has to be a real exchange of debt, basically, of the products. The derivative market that comes out from the SOFR, from this overnight rate, is gigantinormous. If we take the ZN, which is the ZN, which is the 10-year future, interest rate future, the ZN is the biggest single contract, single expiration contract in the world. But if we take this SOFR, it is the biggest in the future space. It is the biggest category of products in terms of let me see if I have this is the steer future small. I will pull up the biggest one. It is the biggest future in the world in terms of multiple maturities. Why multiple maturities are so important? As you can see here, the open interest, so big, so sure, I don't need it so big. You could see that every one of these contract trades until, of course, the volumes and open interest get smaller the further we go. But here you have U, which is September, V, which is October, November, December, January, February, March, and the further we go, for example, here you have March, here you got June. After a few months, it gets quoted not anymore in month by month, but it gets quoted in quarter and quarter because there isn't need for so much liquidity, and so they get quoted in quarters and quarters. Quarters are extremely important in the whole financial world, because even in the corporate world, so equities world, it is super important in the Treasury and for the central banks as well, because the quarterly meetings for the central banks are also those where the summary of economic projections and the respective names for different economies comes out. So where the central bank, which is, I don't know, probably the second or if not the most important entity in the financial world, lays out their expectations in terms of growth, inflation, job market, and their monetary policy based on their projections. What we know about it is a little parenthesis. Powell will stay in office until June, and he was known for being like very, very true to what was being said during him as a chair. We don't know still who will come later. So why they are so important? So quarters are so important also in futures, because the quarterly expirations are super important because they correspond to the quarterly meetings, and the software futures could be used, and they are used to express, like to hedge, and so to express participants' view on future monetary policy. This is one of the main uses. So the big participant, nobody in the retail space except a bunch of us, like we are a very little volume, trade software futures. So we could say that these are big participants, that they are hedging the risk of monetary policy. So for example, the calculator. So for example, you have here the price, and here you have implied yield. The software futures are quoted in 100 minus the price. So for example, let's take December minus 96 points. Sorry if I'm 3. Where is it? 335, 3.65, and here you've got. Sorry. Where is it? Yes. I did a bit of a mix, yes, because I used, yeah, but anyways, 100 minus the price makes the yield, sorry, yes, here was December, 96.95, 100 minus 96.95 makes 3.095. So here the implied rate shows you essentially in December, not by surveys or nothing or that kind of stuff, how much, where the market expects for the rates to be in December. Here you have March, here you have June and September. It is pretty much in line now, because at the current rate, they have projected to lower the rates, including September, by 1.25 until next year, and so 3.095 and in December 2026 is very much appropriate. So it's very much in line. Here in March, 3.5 is appropriate because they probably cut December, probably also October, like some banks and external economists, probably even either we are going to be probably another 2 this year, like the federal bank said, and another one next year, and that will bring us to around the 3% in rates. So you could see how powerful this is as an instrument, just to make a kind of analysis. This could be also used to trade, because not always the participants are right. They start to price the events in different ways. So you could use, for example, the summary of economic projections as a baseline. So for example, they say you use the dot plot, and the Fed dot plot, which is an average of where all the Federal Reserve boys and girls, I would say, I don't have the word on my tongue right now, you have an average of where they see for a year, etc., where they see their rates. You could, for example, trade the software futures with spreads or the outrights if the market goes out of line, if they start to price too much for an event. So if we had, if I plot a chart, for example, for Z, which related up chart, where it's going to open over here, it priced different stuff for in different moments of the year. For example, if you plot the daily, see, for example, the higher the price, remember, the lower rates are expected by the market. For example, it went too far away. Yeah, so for example, 2025 here, over here in April, the price was much higher. Or for example, last year it was very, very high, and then it normalized going forward, and eventually just before the event, the FMNC September, it was very much in line. You could also see like this, trade this in spreads. For example, if you plot, for example, December next year against December this year, so you make an average of where do you see it is more effective in terms of risk management. Also, you could trade the spreads on the normal curve. So, for example, they are called the ICS, so intercommodity spreads. I'm going faster now because we are getting closer to the end of the webinar, and it's a bit confused. So, you, for example, can use the futures. They are you have lower margins and better risk management to trade, for example, the 2s against the 5s, or the 10s against the 30s, or the 20s, and so on and so forth. And it is much more effective instead of trading the spreads on. You basically trade the shape of the curve. By trading the shape of the curve, I got over here. By shape of the curve, I mean, let me put this in white. So you couldn't just trade, for example, I want to go along the 2 years, and so if you go long the 2 years future, you expect the yield to come down, for example. So if you go longer, you want the yields to go lower, but you could also trade the shape. So if you expect this part of the curve over here to come closer to this part of the curve down here, so for example, something like this and like this, you could do that as well. This is called a flattener, and of course they're not going to trade the curve moves all together, so that pretty much, and so if we are going up the 2s and until the 30s, they're going to move in quite a sync. You will see this is the DOM. It's where we base our main analysis. At least it's where I base my main analysis. You could see the volume profile over here is quite similar across all the curve over here. So they made pretty much the same movement today. It's just how much more or less one part of the curve moved against each other. So in that case, you could have bull steepener or flattener. You could have a bear steepener or flattener. I strongly encourage you to delve more into it, especially having seen it as a tool. It is very powerful to this kind of analysis. What we do is base our analysis on underlying and taking into consideration a lot of information from secondary markets, OTC markets, and futures markets, to then trade the futures, because they are much more effective. You have well leveraged money, and it's much better. But I don't think that I have more to say. Coming back to my Xenit workspace, So coming back to my Xenit workspace, it's pretty straightforward. It's what you see over here. I don't know why all of these added. I probably started to click and they were linked. So here, yeah, there's going to be, yeah, we need to fix this later. It's pretty simple. I've got this 10-year chart, the euro over here, the curve here, the overnight index swaps, the software OAs, and the software futures, and the spot market for the Treasury. And I've got a filtered news feed. I don't use many feeds, like somebody might use different feeds for example, if they trade commodities or other markets, but I prefer to have just one with everything that I need. It's basically everything that I need over here. So yeah, newsfeed, and it's pretty straightforward, and this is it. Before the workspace migration, it was more intricate because we had access to. I'm one of those that liked the previous version more, but the workspace is still very nice. And yeah, and this is a secondary screen. I have a third screen, which is essentially, it is quite simple. This is another quote board, but for futures of this is again the treasuries. This is a real-time short-term interest rates futures. I've got the European markets because I trade the European curve as well. I've got a quick look into equities across the United States and the more important European most important ones as well. I've got a look into the FX market because I want to look at, for example, the euro future. I want to look at the Swiss franc, and I want to look at the yen, because especially the Swiss franc and the yen, they during particular moments of and events, they are highly correlated with spot prices and inverse then to yields, and they give some kind of extra confirmation. This, for example, if we are into a risk-off regime or a risk-on regime, so if equities fall and rates rise, we also want to see yen and the Swiss franc to gain as well, and that presents also an opportunity to operate onto different. So you could, for example, be long the yen, so the 10-year future. You could be long the Swiss franc, and at the same time being short the ES. Order flow allow us to be very, very highly precise using order flow analysis. So it's a very, very important and nice. It is our specialization. We have let me put this over here. Okay. We have, like I previously said, if you want to join us, we have a community for our English speaking friends. It's called, if you want to delve deeper into this, it's completely free, and it's called Mr. Order Flow. We have, of course, my Mr. Order Flow. I'm not Mr. Order Flow. I'm Jagger. Mr. Order Flow is the founder, and I'm just I'm an extra. We are partners, and if you want to join us, we have also a YouTube channel which explains a lot of order flow training as well. Our community is completely free. You have broker deals, our Xenit deal, deals for platforms, and a lot of a very friendly community. We had more than 1.2 thousand of us. And for our Italian-speaking friends, if you want to join us, I'm also going to I'm working with an Italian trading school. It's called Quantistes. They are specialized in options and futures analysis on the indices, and so on the SPX and DS futures. very approaching it from a quantitative perspective. So it is very interesting. And I'm doing a 2-month intensive bootcamp with them, specializing in treasury trading, starting toward the end of October. But it's going to be in Italian. If somebody of you speaks Italian, just hit me up. The classes are officially closed, but maybe we could fit somebody else. We could see, or just look into the future if we can do it again. So I think that I'm done. Jeffrey, if you want to take the lead now. I think that I basically essentially said everything that.
Thank you. I did find the YouTube link. I'm going to go ahead and click it up here, so everybody can jump in if they want. Do you guys also have a website, Jagger?
No, we don't have a website. I just have a website for Quantistes. It is quantistes.spot.pro. But it's for the Italian side. I have my little page there, the fixed income bootcamp. If somebody speaking Italian wants to join for like the bootcamp or the future ones, we might be doing this with Mr. Order Flow in the future in English as well. It will be very in-depth, like intensive 2 months, more than 100 hours of content, live markets, and so on. So it might be interesting.
That sounds cool. Luke had a question that I wanted to throw at you, and I think it's kind of interesting. It's very topical. The question is how do government shutdowns usually affect Treasury futures pricing and liquidity?
Right. So how they usually? The last time we had a shutdown was in 2018. So it was every shutdown is a little bit different. So this time, how it affected it was we had I went to do a little of a deeper analysis. So the first thing that we had tonight was the going into the start of the session today was the VIX gapping up at in the morning, so heightened liquid volatility. However, also at this time we had the dollar falling because yes, we had the dollar falling today a little bit, but not so much. A government shutdown like this one, like we had right now, isn't such a big an event. It is a smaller entity because a shutdown implies that only the non-essential parts of the government shut down. So it is more of a political weapon, I would say, between the Democrats and the Republicans to like threaten each other. The Democrats don't want to pass the bill, and so they will like force some parts that the Republicans like to shut down, but also vice versa, that allows the current government to like shut down forever some parts. But how does that affect? Heightened liquidity on equities also mean heightened liquidity on treasuries because of the inverse correlation on between treasuries and indices. So when the treasuries rise and the indices fall, we have a risk off, and so we have a bigger volatility on treasuries, just as we have on equities. Most of the shutdown was already priced in because we were talking about it since weeks already. So the effect wasn't so big, and it's going to just normalize and just stay normal. And that wasn't such a big of. I don't see any. I was looking since the morning today because I monitor, for example, in the overnight session how the liquidity looks and what are the volumes, but there was literally almost no difference of how it was Friday or Thursday. So a little bit of volatility in the beginning, but quickly normalizing. That it is. It is just more of a political weapon and kind of thing.
All right. Jan says, difficult stuff, easily explained. Thank you, Jagger.
Thank you for participating.
Sanjay says, great webinar information. Is this recording or are we recording right now? And I did include the YouTube link if you're watching this now, and if you registered, you'll get a copy of the YouTube link within about an hour. So that'll be coming.
Okay.
I also did post it in the comments as well. If you are watching us on YouTube, it's the same link you're watching it on. It doesn't move. So there you go. That looks like all the questions. One of the comments I had, I really like the way you've got your Zenith workspaces put together. And so I'm going to talk a little bit about Zenith. Give a special offer for that for people that don't have it. Before I do that, though, I'm gonna now call you Jagger forever. I want to thank you for joining us, Jagger.
Thank you for having me. I really enjoyed it. Sorry for my English, because talking about it in. So I started kind of slowly, but then I was looking at the clock. I was saying, I want to say so much stuff, and it is kind of it's not my natural language, so I'm quite
You did great. You did way better talking about that than I ever could have. So thank you for spending some time with us. I appreciate it.
Yeah, I really enjoyed it very much.
Cool. Thank you very much. All right, I'm going to go ahead and just kind of talk a little bit about Zenith for a minute. And again, thanks, David, for coming in, spending some time with us, that kind of stuff. They just finished reworking what we call our Zenith application. I want to kind of just talk a little bit about what it is. It's an institutional strength newsfeed, and the screens that Jagger was showing. I like that as a nickname. It's going to stick. The screens that Jagger was showing we're in basically the Zenith application. So it is a professional grade. It's basically powered by Reuters News. It is basically the what used to be the Thomson Reuters infrastructure. It's now wholly owned by the London Stock Exchange Group. And when if you're an institution, you're subscribing to their data feed. Basically, you're getting a very, very similar product. So as part of this, what they're giving out is comprehensive real-time news, data, information, and just to kind of give you some numbers, pricing for about 70,000 globally listed companies, 40 million items of research available, real-time news from 2,600 full-time journalists across 200 different news bureaus. They cover agriculture, commodities, emerging markets, equities, FX, metals, energy, all of that kind of stuff. So pricing for this, if you want to get set up for it, it's about $110 a month for our entry-level package, the FX package. It'll include real-time FX, global delayed for other markets, and news analysis and reports. We also have a regional package, which the regions are America, Europe, Middle East, and Africa, and Asia Pacific, and that's $165. That'll get you to the same thing: real-time FX data, global news, analysis reports, but the ability to also go real-time in the exchanges that you want to see real-time. And there will be some exchange fees, like for example, New York Stock Exchange. If you want to get New York Stock Exchange real-time, I believe the cost is just about $4. It's not expensive, but it varies from exchange to exchange to get that real-time data. So the offer that we're going to do here is what we call an extended trial. If you pay for a month at 110 or at 165, either of those rates, what we're going to do is give you the second and third month for free, which literally will have you running this into next year, like 1/1/2026 today, which is hard to think that that's like 90 days away. But so if you pay for it now, you'll get 3 months for the cost of 1 month, and you can do that. Actually, I meant to.
Hey Jeff, I'm sorry to interrupt you. Is that link you're showing correct? I just
No.
didn't know.
I thought I had updated it, but I'm not sure why it didn't. So it's
okay. I was I was going to interrupt earlier, but I thought, well, maybe he just knows something I don't.
yeah. I had to actually type this in. I wonder, in any case. Yeah.
Well,
You
let
can
me
do
check
that.
really quick. That link is, did you check that link?
No, and
Well,
I
I'm sorry for interrupting. Let me check it right now and I'll post it.
it's right here.
And,
It works.
oh, okay, perfect.
All right. So if you go to metastock.com, thanks for the assist too, Greg. Actually, that was a typo. Mr. Orderflow 3-for-1 will take you to a page where you can sign up for that extended trial for Zenith. If you have questions, you can give us a call 800-882-3040 or go to metastock.com/saleschat. So want to thank Jagger again for joining us. And there you go. Thanks, Jagger. Thanks. Also, don't forget to like and subscribe if you like the event. And I hope to see you in a future one. Stay healthy, stay well. Give this a go. It's $110 and I'll get you running through next year. Thanks again.